Welcome back to the Neuro Finance Masterclass. This document is day 98 of our 365 Days to Financial Freedom series.
That's right. Yesterday, we completely mastered the external clock of the market through seasonality. But today, we're shifting our focus inward to liquidity ratios, the financial health checkup. We're going to take our surgical lasers, bypass all the marketing hype, and point them straight into the actual financial engine of the companies we're looking at.
Let's ground this right away and make it incredibly real. Think about something we all understand intuitively, your own personal finances.
Exactly. So imagine side A is the physical cash sitting in your wallet right now, plus whatever is in your checking account. It's totally liquid, it's yours, you can spend it today. Now look at side B. That's your looming credit card bill, and it's due in exactly 30 days. If side B is vastly larger than side A, well, you're going to lose sleep, you'll have to scramble, maybe borrow more money, or sell something off just to survive the month. Corporate finance is honestly the exact same concept, just with a whole lot more zeros. We're just measuring immediate cash against immediate debts.
And honestly, this beautifully illustrates the main dividing line in the investing world. You see, an amateur investor will look at a company's stunning glass-walled headquarters. They read those flashy PR statements about, changing the world, and they just buy the stock blindly based on pure emotion and narrative.
Right, but an architect? An architect completely ignores the noise. We look directly at the balance sheet to ask the most brutal, unforgiving question in all of finance. If an economic crisis hits tomorrow, literally, if revenues drop to zero overnight, does this company actually have enough emergency cash to survive its immediate debts? We don't want promises. We demand mathematical solvency.
So, how do we actually measure this? Well, we use our very first diagnostic tool, which is the current ratio, or jarioran. This is the absolute baseline metric for your neurofitness.
And the math here is just beautifully sharp. You take the current assets, that's dönen varlıklar in Turkish, which includes cash, inventory, and receivables that can be converted into cash within one single year. Then you simply divide that number by current liabilities, kısa vadeli yabancı kaynaklar. Those are the debts and obligations the company has to pay within the next 12 months. It is literally exactly like dividing your bank account balance by your upcoming credit card bill.
Okay, so what do the results of this equation actually tell us? We categorize a company's financial health into 3 distinct thresholds based on their current ratio. You've got the danger zone, the sweet spot, and the inefficient zone. Once you master these 3 thresholds, you can instantly diagnose a balance sheet in like less than 10 seconds. Let's break them down one by one so you know exactly what to look for. The absolute most crucial point here is knowing when to run away. If you run the math on the current ratio, and that number starts with a 0, say it's 0.8, this is a massive, glaring red alert. A ratio below 1.0 mathematically guarantees that the company owes more money in the next 12 months than it can easily generate. It's running on incredibly thin ice, and it is completely trapped in a liquidity squeeze.
Absolutely. If the credit markets freeze up even a little bit, or if revenues take a slight dip, this company is staring down the barrel of a brutal restructuring, or worse, bankruptcy. As an architect, when you see a 0.8, you don't stick around. You walk away.
Now, let's talk about the optimal zone. A current ratio hovering between 1.5 and 2.0, so let's say a 1.8, is what we call the golden sweet spot. This is exactly where you want a healthy, aggressive company to be. Why? Because a 1.8 means that for every $1 of short-term debt, they have $1.80 in short-term assets ready to deploy. They have a really comfortable shock-absorbing safety buffer to pay their bills, survive unexpected macroeconomic bumps, and still keep the powerful compounding machine of their business running smoothly. But hey, more is always better, right?
Actually, no. If you see a current ratio soaring way up to 3.0, 3.5, or even 4.0, that immediately throws up a yellow flag for inefficiency. Just think about it for a second. If a company has 3.5 times more cash and short-term assets than it actually needs to pay its bills, what is that money doing? It's just sitting idle. It's collecting dust instead of being aggressively reinvested into research, development, new acquisitions, or returning capital to shareholders. A ratio this high often tells us that the management team lacks the vision to deploy capital effectively.
Okay, so let's say you've checked the current ratio. It sits at a beautiful 1.8. You feel safe, you feel totally secure. But let me ask you this, Ibrahim. What if that 1.8 is a complete mirage?
Oof, yeah. That right there is exactly where we separate the good analysts from the absolute masters. Because the truth is, the current ratio can actually lie to you. It can hide a massive structural flaw right beneath the surface.
The ultimate trap in basic accounting is inventory, or stock LAR. Remember, the current ratio includes inventory in its calculation of total assets. So imagine a company that manufactures thousands of running shoes in this incredibly hideous neon green color that nobody actually wants to buy. Those shoes are just sitting in a massive warehouse, gathering dust.
Right, and on paper, on the official balance sheet, those ugly shoes are counted as an asset, contributing to a super healthy current ratio. But in reality, come on, you cannot pay your warehouse workers with neon shoes. You certainly can't pay your bank loans with unsold inventory.
And this is exactly why we need an ultimate defense mechanism. Enter the quick ratio, or acid testosterone. This is the real stress test. To find the true, undeniable solvency of a company, we take the current assets and we completely strip away the inventory.
Yep, we just subtract it right out of the equation. We are only measuring the absolute most liquid, raw assets here. Pure cash, marketable securities, and accounts receivable. We take that heavily filtered number and divide it by the current liabilities. It's ruthless, but it's necessary.
Ibrahim Architect demands a minimum quick ratio of exactly 1.0. This is the gold standard of mathematical solvency. A quick ratio of 1.0 means that even if a catastrophic event happens today, I'm talking global supply chains freeze, customer demand completely evaporates, the company stops selling its products entirely, they can still pay off 100% of their short-term liabilities using raw cash and immediate receivables. They absolutely do not need to rely on the hope of selling old inventory. A quick ratio of 1.0 means you want a fortress.
So how does all this apply to the broader economic cycle? We use what we call the leverage filter. Let's look at the expansion phase first. During an expansion, credit is cheap, the economy is booming, and aggressive debt can actually fuel hypergrowth. We call this good debt.
But listen, the macro season always shifts. It always does. When the economy inevitably transitions into a winter recession, that exact same leverage becomes a lethal anchor if the company's liquidity is below 1.0. The debt that pushed them to the moon during the boom will literally drag them straight to the bottom of the ocean during the bust.
And this brilliantly illustrates exactly why architects survive market crashes, while amateurs just get completely wiped out. Take the amateur stock. The amateur bought a company with high debt and a liquidity ratio below 1.0 just because the stock price was going up and the PR was fantastic. The second the recession hits, they lose everything. Now look at the architect stock. We filtered for healthy debt and a liquidity ratio right in that 1.5 to 2.0 sweet spot. By relentlessly running the current and quick ratios, the architect filters out those high debt, low liquidity traps months or even years before the crash ever happens. So here is your cognitive task for today, your direct actionable mission. I want you to perform a solvency audit. Step 1, pick a prominent stock from your personal watch list right now. Step 2, open its balance sheet on your financial terminal or your favorite screener online. Step 3, find the total current assets, subtract the inventory for the quick ratio, find the total current liabilities, and actually do the math yourself. Calculate its current ratio and its quick ratio. Put your own stocks to the ultimate stress test today. Because at the end of the day, you have to ask yourself, is your company a bulletproof fortress, or is it an over-leveraged house of cards just waiting for a strong breeze to knock it down?
Stop trusting corporate narratives. Run the numbers and you will rule the cycle.
Thank you so much for joining us on this explainer. Keep demanding mathematical solvency, and we will see you at the next masterclass.